Hello, this is Charles Conrick, Vertical Option Spreads, the 1.8 standard deviation inflection point. This is part 4 of our discussions and training with the trading spreadsheet. Again, this is part 4. Quick review. What have we done so far? Well, in part 1, we looked at an overview of the spreadsheet, if you recall. That's really all we did was we looked at a general overview of the spreadsheet, and I tried to show you, okay, this is how it works and why it works. We went over tab option 1, this sheet down here where the yellow cursor is, and I had mentioned to you, in addition to being the long put sheet, labeled at the very upper left of the screen, right up in here, long put sheet. It's also your major input or central, it's input central for the annual return, the historical volatility, the asset price, the implied volatility, which would imply to this option, your interest rate, the strike price of the long put, and the time would be computed for you. You can also change the volatility of the volatility, which I told you, at least in general, can be estimated to be about anywhere from 30 to 60% of the historical volatility. So I usually leave that about 5 unless I have strong evidence otherwise. And then you have the standard deviation calculator spinners right in here where you can actually look up where would a certain, where would you be insofar as a standard deviation. So for a 170 asset, I could just type in a 0 right here and it'll show you standard deviation at 170 in either one of these little calculators will show you you're nothing away from the asset price at 170. So that was the long put. The next sheet, well, let me approach this another way. We also then covered tab options 2, 3, and 4. And you might remember now, if we go all the way over to tab option 4, that's going to be our long call. Long call. So 1 and 4 are kind of corners, if you will. Long put on option 1, long call on option 4 sheet. And you might recall that since the input central was on tab option 1, the days to expiry is grayed out and not available to you, as is annual return, historical volatility, the price. The implied volatility you can change to match whatever you want on the long call. Interest rate is grayed out or browned out, if you will. Strike price is up to you. You can change that if you wish, no problem. And the time is grayed out to you. So the only real purpose of this sheet is to set up a long call. So option 1, option 4, those two sheets are longs, long put, long call. Now for the purposes of spread trading, and then subsequently with this particular lesson or trading part, this will be part 4, we're going to cover in some detail tab options 2 and 3, which are going to be short positions. Option 2, clicking right here, option 2, tab option 2 will be a short put, and tab option 3 will be a short call. Make the screen a little bit bigger so we can look at it easier. So we have your short positions in tab option 3, short call. Tab option 2 is short put. So here's where we're selling a put and selling a call. Now clearly what I'm doing here is setting up systems where I can use the various tab options, 1, 2, 3, and 4. So long put, short call, long call, to invoke various positions insofar as spread trades are concerned. Now going to the net sheet, farthest left over here, farthest left is the net sheet, and the net sheet is where we're going to use the switches, if you will, which are right here where it says active, to basically just do what it says, activate the various positions such as long put, buy put right here, short put sell, short call sell, and long call buy. So if we activate These are just toggles. If we activate all the positions, well, then everything will be evaluated in the simulator. You'll notice that on this particular spreadsheet, I finally added in the asset itself, long asset here in column B, where I'm kind of playing with the yellow cursor. And I decided to do that, and I'll make sure that you get a copy of this sheet on the website here very soon. It was a little tricky, nothing major, but this implies, like, what if you wanted to look at just buying the asset? And so before I get into my lecture on the short put and the short call, I'd like to show you how that works. If I switch off all of the options, so as you notice on the switches, I'm switching all the call and puts buys off, and you can see all the zeros are filled in. So let's pretend that for however you did it, and we'll go back to tab option 1, you've got an asset priced at $170 per share. And you think the historical volatility for the next year is going to be 11%. And you have no idea what the annual return is going to be, but you think it's up. Maybe your fundamental analysis says to you, geez, I think it's going to be up 10% in the next year. Well, what you could do is just simply take annual return and click it up to 10%. Now, if you wanted to analyze a whole year, what you'd have to do in cell B2 or go 1/10 of a day at a time, you can kind of see what I did here, but it would be easier if you just typed in 3,650, and that'll put 365 days in there. Do the same thing here. And now we're going to look at what this asset will do, assuming that you buy the stock. So I'll go back to NetSheet, and because an option represents 100 shares, if I'm going to trade one option in the puts and the calls, as you can see that I have up here at the top of the screen, the implication would be to play with this to see different setups of positions. I have to pretend like I'm going to go long 100 shares, because one option equals control of 100 shares of stock, and this makes it the easiest way to run an analysis. But if you wanted to see what this asset would do under the geometric Brownian motion model, you could easily just click the big spinner here, and you'll get some scenarios. So if you bought the asset, now in that scenario, I lost $1,774, and in this scenario, it would have went up. So I would have invested $17,000. 100 times 170 is 17,000. And according to me, this stock would have went up approximately, what is that, about, all we need to do is look at the very bottom of the sheet. And the stock would have went up, if you look at the very bottom here, where I'm reverse highlighting, the stock would have went up to $200.82 per share, which would give us then a net, about, what is that? That's 30 some odd dollars a share times 100. Yeah, that would be $3,000. But if we do this again, then clearly what we're going to see is, oh, we made 4,000 that time. Then we made 3,000. Now we lost 3,000. That would imply that the stock went down to 140 a share. And certainly we can use Crystal Ball then to run this. I've got it set for 3,000 iterations. Let's see what would happen over a 3,000 iteration period, just owning the stock. So just give Crystal Ball a minute, and it's going to begin running all of its iterations. And it's going to give you the probability distribution of what this stock would look like, and more importantly, what would your trade look like, and then give you some statistics. So if you bought this asset and you were interested in breaking even or making some money, according to Crystal Ball, over a sample size of 3,000 trials, we'd have about an 82% chance of making money on this stock with a mean expected value of $1,800. So $1,800 divided by 100 is $18. The implication is that normally, based upon your assessment, this stock going up 10% would go up to about $188 a share, which makes perfect sense. If your assessments are correct, I mean, it's almost a self-fulfilling prophecy. You're telling Crystal Ball that Assume that this thing's going to go up 10%. Of course, the problem is with the concept of geometric Brownian motion, which closely resembles stock movements. We just don't know what year or what iteration it's going to happen. It could go down, like you see here. It could go up. It could go up and down. I'm trying to look for there's a nice wiggly one this would represent one whole year. So approximately, if you look at the way I've got this scale set up, here'd be about 6 months out. Well, you'd be in this trade for 3 months and not have made any money. Then about 6 months later, you would have been up to the peak. And if you held it for the whole year, you would have actually lost off the peak. So timing a stock, as we all well know, is very, very difficult. Here's a situation where you would have been down for almost 6 months, then the stock would have climbed back up. You'd have been up 1,500, and then the stock closed down toward the end of the year, and you'd have been up 500. And this is pretty much there's a good year. Obviously, there's a good year, pretty good year, but a little volatile. I'm just looking at some various. There's a very interesting and predictable year. Even if the stock is predicted to go up 10%, in this particular year that you traded it, it went up for a bit, then went almost straight down. You lost $1,500. Then it came back to almost break even, then went back down again to late in the year by about this would be say about October 1st. Now it climbs back up again, and then finally toward the end of the year, you'd be down $500. Now the question is, do you want to trade this way or not? I mean, it's all up to you as an individual, regardless of your system. So interestingly, what if we took this and said, well, I don't know what it's going to do, but I like it. It's a good stock. And you've set this at 0%. In other words, I don't know what it's going to do. What would crystal ball say then? And you should be already able to guess at it that crystal ball is going to say, I don't know either, which is pretty much true of all of us. So let's let it run 3,000. This would be like 3,000 trials or 3,000 different years that you're looking at, and you're getting a sample size. So now all of a sudden you can see that the odds are clearly almost 50-50. Crystal ball is telling you if you want to break even, it's going to happen about 48% of the time. Your mean gain on the positions, if you did this 3,000 years in a row, would be it's a negative $9, which you can see where I have the yellow cursor. But in effect, you'd be breaking even. And what's happened here is sometimes your $5,000 stop loss got triggered, in fact, almost 20% of the time, which means you got taken out after you'd lost $5,000. That's why you've got that high spike on the end. So this, ladies and gentlemen, is probability trading. You're not sitting here guessing in the sense of probability estimates. You're effectively attempting to put probability theory to work. And my own particular experience, studies, and theories do not go with picking a stock. Now, if you can, then certainly go ahead and if you think this Standard & Poor's is going up 20% next year and you run crystal ball, I guarantee you the probabilities will show you being very, very accurate. So just running crystal ball very quickly, you're going to see that your chances of breaking even are remarkably good. So let me get to the net with stop position, and yeah, see, probability-wise, if you predicted going up that much, you have a 94% chance of breaking even. So by all means, go for it. And that, of course, is a function of what you pick as to put into this annual return, and of course, what you pick to put in for volatility. Volatility is going to stretch out the wiggly lines during the course of the year, and the annual return up or down is up to you. There are plenty of good books out there on how to pick stocks, what to do with stocks, when to pick stocks. That's not what my theories are about. My theories are strictly about probability theory, and we'll be getting into that in more detail later on. But the purpose of this trading sheet is to allow you to assess probabilities. How a stock or why a stock's going to go up 10% next year or 20%, I leave to the talking heads on NBC or CNBC and Fox Business and Bloomberg and you and all of your whatever course you pay for. I have no idea what makes stocks go up and down other than the market saying to a stock, there's more buyers than sellers. And a stock goes down when there's more sellers than buyers. So that's not the purpose of our course here. All right. So that when I put this up, which will be shortly, certainly within the next 60 days or so, and today is November 30th, 2013, gives you a time frame. You'll have the long assets you can play with, and of course you can switch it off as well, just like every other one, so you can strictly play with assets. The main reason I put it in was I wanted to combine it with a couple of the tab option 2 and tab option 3, the short call. So why would we, well, first let's look at the short put. Why would you ever sell a put? And selling a put, again, I remember I had mentioned Anthony Saliba's books on options, very, very good introductory books, and there's a bunch of fine ones out there. Russell Rhodes has an excellent book on spread trading. I'm not really interested so much in teaching how to trade spreads. It's covered in my book as well, but it's not the purpose of what we're doing here. The purpose of what we're doing here is strictly an assessment of probability and using this wonderful tool of crystal ball with Monte Carlo simulation. And we're going to be getting a lot deeper than where we're covering now. These are strictly the introductory sessions. All right, so that being said, why would you ever want to sell a put? Selling a put gives you the obligation to buy a stock. So the only time you would really want to short a put is if you thought a stock was going to go down, okay? Excuse me, you thought a stock was going to stay up. I beg your pardon. If you thought a stock was going to stay up, you could sell a put and make the premium on it. And also, you can use a short put as a part of a spread trade. You go long the put, you long one put at a lower strike price, if you will, and then you go short a put at a higher strike price. That would be a bull put spread. Or you might want to go, that would be a bull put spread. And a bear put spread would be long and in the money put and short and out of the money put. So I should qualify that. A bull put spread would be long and out of the money put and short and out of the money put in order to catch a credit. A bear put spread would be long and in the money put and short and a lower strike in the money put, which I've already taught you in the previous lessons, to basically you'd pay a debit on that trade, but you'd be hoping that the asset kept going down and that your put spread would make you the difference between the two strikes minus the premium. All right, so that gets complicated, but you can read about that all in a book. The purpose of my structure here is to, all right, you want to set up the short put. Well, don't forget on tab option 1, you've already set in all your assumptions for annual return, historical volatility, the price of the asset, and any volatility of the volatility squared, as I call it, the pink cell. Now, if you wanted to set up a short put, you're going to enter the strike. So if you wanted to go short and at the money strike, you would simply click here to 170. Now you would go, oh, by the way, let's reset this to a more manageable period, like 30 days instead of a year. Because obviously with that kind of time value, we're going to have a very high priced put. You could go to an option chain, which I will get to in very shortly. We'll start incorporating actually putting down trades. But you'd go look up the price of the 170 put. Let's say it was, I don't know, $3. Well, lower the implied volatility till you get the very first cell, the yellow cell, to $3. And this should very, very closely match what the implied volatility is on your option chain, on your brokerage desk. So the implied volatility with 30 days left to go for a 170 and at the money short put should be about $3. To check it, you might want to go and look, what would the long put be at, I forgot what volatility I used, 15 and a half. If you used a 15 and a half implied volatility, we'll set this to 15 and a half, and let's set this to 170 as well. And you'll see it's also $3. So a long put or a short put at 15.5% implied volatility, either one, it's going to be worth $3. Now, why would you ever long and short that trade? Well, you wouldn't. So that being said, if you wanted a bear put spread, what you might do is buy the 171 for, say, 353 or 360 and sell the short, the 170. That would be a bear put. And then you'd hope that the asset would would go down, and you'd be able to, you'd be making some money on the spread. Okay, and I'll be covering in the next session or two, the next two sessions, we will put together short spread trades. The purpose of this lesson 4 is simply to show you how to set up the strikes and set up the prices in the first cell. After the first cell, the one colored in yellow here, after you set the price, the rest of these numbers below, all the way down to the 395 sample size, is set up for you such that, or figured, computed for you using the Black-Scholes model. So after that, after you set it up, you're ready to run your crystal ball. So that would be a short put, and tab option 3, which is the short call, okay, at the money. And let's say we also wanted to go at 15.5% implied volatility. Now there, as we've mentioned before, because of the log normal distribution, call will be a smidge more expensive at the same implied volatility. It's just a function of the mathematics. So the put is $3. The call at the same implied volatility will be approximately 307. Obviously, these numbers are subject to some rounding error, but that's in large part due to the log normality of the distribution. So the call will be a little bit more expensive than the put. Two 10% moves in the upside is worth more than two 10% downside moves. That's part of the log normal distribution. In other words, if you start at $1 and you go up 10% twice, you're $1.21. If you start at $1 and go down 10% twice, you're only down to 81 cents. You've lost 19 cents as opposed to gaining 21 cents. Because in the log normal, you can never go below zero. So on the downside, you're constrained to having zero as the bottom. On the upside, you're constrained to infinity. This is not a math class, but fundamentally that's the reason for the difference in the prices. Now here we could definitely set up a trade. So let's pretend that on the net sheet, and let me walk you through a trade here in a crystal ball situation, or a simulation rather. Here's a very popular trade, and you may already know or have guessed what I'm going to do. I'm going to pick, let's say we own 100 shares of the stock, and we decide to sell a call against our position. Well, that would be a covered call, which is a very, very safe and popular position for people that own a stock. So the scenario is we own 100 shares of XYZ stock priced at $170 a share. That's $17,000 that we own. We bought the stock for $170. All right, here we are at day 1 of the option period, and we go to tab option 3. We've got a 30-day to expiry trade, and we are confident that this trade, XYZ, this stock, is going to do absolutely nothing. It's just going to sit there at 170 for whatever reason. On the other hand, if a more realistic thing, and we'll just go ahead and do it let's say you thought that, wow, there's no way it's going up more than a couple of dollars in the next month, in the next 30 days. This would even be a better example. And you think, I'm going to lower this to $200 or $2 if you don't mind, just for ease of discussion. So you'll see where it says short call, we have $2. Well, 100 times $200 is $200. So the scenario is you own the asset for $170 and you decide to sell a call against it, against your ownership of this stock for $2 each. 2 times 100 is $200. That, ladies and gentlemen, if we go back to the net sheet, is the most that you can make on this trade. So when I play with this, the most I can make on this trade, why is it telling me more than that? Hold on a second while I look at this. I think I had it set up right. Short call at $2 is correct. Bear with me 1 second. I've got the switches set correctly, so I'm all right. Why is it showing me making? I've got one at 200 and 100 at 170. All right, well, without getting into a great analysis here of what in the heck did I do wrong, I'm trying to think that the most I should be able to make on this would be, oh, no, I'm wrong. Oh my goodness, I'm wrong. Yes, it would be the maximum you could make on this is 400. The reason being, and I'll tell you what I'm going to do to get myself unconfused, it's because of the fact that you could also keep the $200 profit on the increase in the asset. Let me give you a better explanation real quick. Let's go to 170. This will make this very clear, and we'll set this even to $3. Okay, so there's $3. Now, since I'm trading an at-the-money call, I'm selling an at-the-money call, the most I can make would be the $300. The reason being is that when I short a call, I've got an obligation to sell at 170. I bought the stock for 170, but now I'm giving up the obligation, or actually, by selling this call and trying to collect that big premium, I've got the obligation to buy it for 170. So the only reason I would put this trade down would be if I thought this asset's going to stay at 170 or below. That's the only reason I would do this trade. Again, that's the only reason I would do this trade. So now what you'll notice, if I go up to the home sheet and I run a few iterations one at a time, the most I can make on this trade will be the $301, which is what I was trying to get across to you before. See, there's an example right there. The most you could make on this trade, regardless of what the asset does, is $301. The reason being is because the strike of 170 that I sold is the same as what I bought it for. So at the end, if this asset goes up to 190, and you could go, wow, I made all that money by selling the call, and I also made $20 capital gain on the appreciation of the stock. The answer would be no, you have not, because regrettably, if this asset goes up to 190, guess what happens at the very end? You're going to have to buy back that call or give up the stock because somebody's going to exercise against you and you're going to get assigned. So that's something you want to be careful of. If you don't want to lose the stock, you may want to trade deep out of the money covered calls. In other words, sell it at 175. The reason that before I was getting that $400 nonsense was that I had a 172 strike and I forgot about it. Well, you can keep 200 of the capital gain if you sell a 172 call. And you can also keep the $200 that you made or sold, you made by selling the call. So you could make a maximum of 400, and for a moment I got myself confused. But this makes it much clearer by playing at the money. So if we didn't know, and how this all ties together, if we didn't know, if we just said, look, we actually think this asset's going to go down or stay even. So maybe we put in a negative 1% annual return. What we want to do now is to say, all right, what is the probability that we're dealing with? So we run crystal ball with long the asset and short the, we're going to be, let me reset the simulation. And we'll restart now the simulation and let it go through its 3,000 iterations. Okay, and now we're interested, what's our probability of breaking even or making the $300 is 72.5% with a mean return over 3,000 attempts of $69. So most of the time, according to Crystal Ball, if we did this 3,000 times in a row, we'd average a profit, and we would break even or make money at least 72% of the time. I can use Crystal Ball's little sliders here to actually find out, well, what if I'm interested in only making $100 or more? That would happen 2/3 of the time. That's $100, roughly 104, 66% of the time. So you're going to make money on a covered call 66% of the time, if indeed you're correct that it's going to stay even or go down. Now, again, later on in the course, we're going to use Crystal Ball to help us determine whether or not these assets are going to go up or down. In other words, we're going to give you some probability theory training on actually assessing, is this asset going to go up or down, based strictly on probabilities. Not so much on necessarily on fundamentals or technical analysis, but based strictly on probabilities, and there's ways we can do that. Time series analysis is going to be the primary method we'll use with Crystal Ball. Regression analysis We can also use Crystal Ball to help us with a regression analysis. And if you're not familiar with the terminology that I'm using, don't worry about it. That's what we're going to be showing you in these lessons. We can use Crystal Ball to begin to use scientific statistical methods to help us in this decision rather than a fundamental analysis is great. Warren Buffett's made a fortune doing it. Technical analysis is great. If it works, you believe it. I put that in my book. I believe that 100%. If something works for you, then by all means use it. I always look for the scientific evidence, and I have found mostly the evidence pointing to probability as being my best way of using uh, to make decisions based upon strictly probability theory. The casinos, as I point out in the book, have made fortunes based only on probability. They don't know when somebody's going to win a jackpot. All they know is that at the end of the day, 1,000 people are going to play it, and 999 are going to lose, and then they're going to give one of them a few $100, so one person goes home happy. All right, so the purpose primarily of this lesson 4 is simply to tell you that tab options 2 and tab options 3 are where you set up your short call and short put positions. After you set up everything in tab option 1, which is primarily where all your inputs are right in here, you can go to tab option 2 and put in your strike price and the implied volatility until it matches what the market tells you the price is. Then you can go to tab option 3, set up a short call if you so desire, use your implied volatility ticker to set the price where the market tells you it needs to be. And of course, you can pick your strike price. Then you can go to the net sheet and click the switches here to activate what it is what kind of trade you're going to be using to run the crystal ball simulation. So all we did today was tab options 2, tab option 3. Now, in the next session 5, where I'm going to want to go is to looking at an asset price and setting up a couple of spread trades. In other words, combining the long put and the short put, and combining the long call and the short call, and perhaps all 4 of them, and then using Crystal Ball to see where it gets us. All right, I'm going to sign off for now. I'm past my 30-minute allotment. I hope by now you're at least getting a good feel for the spreadsheet. If not, go back and rewatch the tapes and make sure that you understand how to work the spreadsheet. And by all means, make sure you get a copy of Crystal Ball. So I'll sign off for today, and I'll see you in session 5.